This is a continuation of the assets section, and we were covering depreciation. We had only started doing the first two methods, so we covered the straight line method, and the second method we were looking at the end of the last video was your declining or reducing balance depreciation. You will recall I said you're declining or reducing balance depreciation. You want to reflect higher depreciation expense in the earlier years and a smaller amount in the latter years. Reason being is for some assets you expect the usage to be significantly higher in the first few years and then to reduce over time. Similar to a car when it comes out of a dealership, the minute you actually drive out the dealership, the actual car's value goes down significantly. So let's look at this example that we were looking at the end of the last video. Little King, you had purchased a truck for $40,000 and you had a 5-year useful life with a $5,000 residual value. They gave you a depreciation rate of 40%. Okay? You needed to use that depreciation rate of 40%, not on the original cost each year, but you're going to be using it on what I said is the book value or carrying value. So in that year, when your depreciation, you'll take the 40% in the first year times the 40,000, you'll get to a depreciation expense of 16,000. But next year, the 40% on 24,000, of course, will be lower. So as your book value becomes lower and you're using the same depreciation rate on that beginning book value, your depreciation expense is then expected to decline. So you're not going to have a constant depreciation expense. You will have a lower depreciation each and every year because we are using that beginning book value. You'll notice that for this depreciation rate here of 40%, we did not multiply it by the depreciable cost of 35. We did not take into account the residual value here at the beginning of this calculation. Where you needed to take into account your residual value is at the end. So in years 4, we'll notice that we had a beginning book value of 8,640 and we depreciated at the same 40%. Our book value at the end of year 4 was 5,184. In that year, we want to only in year 5 depreciate by 184 to get us back to our residual value of 5,000. So in that instance, in that last year, we need to be aware of what was our residual value when we're looking at this truck. And I do not want to depreciate it anything more than what the residual value would have been. So you'll notice even though you calculate this 40% times 5,184, your depreciation expense in that year is only limited to 184 to get your residual value back down to 5,000. Okay, this is very different from your straight line. You'll notice the depreciation expense is going down year after year, and in that first year, it's quite significant. Okay, let's look at the next method. The last method of depreciation I mentioned was the activity-based method. The activity-based method doesn't look at just the number of years an asset is expected to be used over or a depreciation rate, but it tries to allocate the cost based on what you're going to be using it for. So if you've bought a specialized machine and you're going to be using it to produce, you can then use output as a way to determine what the activity is for that machine. Okay, so we're trying to allocate more in activity rather than just a number of years and get a constant depreciation. If in that year we had a huge amount of activity, a huge amount of production, we want to depreciate more. In a year that maybe the machinery didn't do any work and didn't produce anything, we're hardly going to depreciate that machine in that year. Let's look at the example for that. So a Little King's business purchased the truck, remember, for 40,000, same 40,000 that we were using in the other examples. It has a 5-year useful life and the 5,000 residual value. What we're using for this example, for the truck, your activity will now be your expected kilometers over the life of the asset. We expect the truck to have an activity of 100,000 kilometers over the life of the asset. Okay, so if in year one we use the full 100,000, we can depreciate the truck fully in that year. If in a year this actual car just sits flat and doesn't actually ride anything, we actually will have very little depreciation for this truck. So your depreciation is now based on what kilometers did you travel during that period. Okay, we have to provide you with the activity each year. It says, what will be the depreciation expense for each of the 5 years if the actual kilometers, not miles, driven in years 1 to 5 were 30,000, 22,000, 15, 20, and 30. Let's look at the schedule. In this instance, we want to first get a depreciable cost. Your depreciable cost is the same one you're using for the straight line method. So you had an initial cost of 40,000 with a 5,000 residual value. Your depreciable cost that you're going to be using for the activity is 35,000. This is very different to the declining method where we didn't take into consideration the residual value up until the end. Remember, for activity and for straight line, we want to subtract that 5,000 residual value upfront. Since your depreciable cost is now 35,000, we'll be working with that 35,000 with each year's activity. The first year, you drove 30,000 kilometers over 100,000 kilometers. So if you look at my calc here, I've reflected the 30,000 divided by the 100,000 kilometers. And if I multiply the 30,000 divided by the 100,000 kilometers, and I multiply it by my depreciable cost, in my first year, I get a depreciation of 10,500. Okay, that makes sense. So you'll see here, your depreciation expense for that first year will be then the 10,500. In the second year, you've used it for 22,000 kilometers. So there's two ways of calculating it. You can either add up the 30,000 and the 22,000 to get to what your accumulated depreciation will be. So we've now in total used it for 52,000 Ks over years 1 and 2. Okay. If I multiply that by the 35,000, I get to an accumulated depreciation of 18,200. But remember, this reflects both years 1 and 2. Okay. So since I have already recognized in that year, last year in your income statement, 10,500 relating to the first year, your second year will just be that 18,200 less the first year's depreciation to get you to the second year's depreciation. Or another easy way of doing it is to still take that same 22,000 divided by the 100,000, and then you need to multiply that by the same depreciable cost of 35,000, you'll also get to the same answer of 7,700. So just remember, in this year, we're looking at each specific activity, and in this instance, it will be the kilometers that you drove each and every single year. You'll notice, same with straight line value and with residual value, the declining balance method. In years 5, your residual value will be the full 5,000 that you actually wanted to calculate. Okay, so all three methods are quite easy methods to understand once you've picked up what you need to do with also the residual value. Okay, straight line activity based, take into account the residual value at the beginning. Declining balance method, remember at the end when we're using that depreciation rate, we need to also take into account what that residual value was for that calculation. Okay, a lot of people get confused between what accumulated depreciation is and depreciation expense. Accumulated depreciation, remember, you're combining every single year's depreciation. So your accumulated depreciation at the end of years 2 will be years 1 and 2's depreciation combined to get you to the 18,200. Book value will be what will be reflected in your statement of financial position or your book value at the end of every single year. Okay, so now that we've completed that activity-based method, we need to also look at what the impact of the depreciation will be. Your impact of your depreciation, this one will produce a steady depreciation. Your accelerated depreciation method will be going lower every single year. And your activity will be based, it will just vary based on what your actual activity has been in that period. Remember, I also spoke about an impairment in the first session, in session 3, part 1. In terms of your impairment, you need to recognize an impairment when either your market value of your asset has declined. Okay, so let's say your machinery was initially worth 100,000 Rand and now it's only worth 60,000 because new machine has come into being. We need to then reflect that decline in the market value. If there's been any changes in regulation, changes in usage, or changes because of physical damage on obsolescence, or the asset is now held as part of a disposal, we need to factor in all this and say, okay, maybe our asset at the end of year 2 for this Little King truck was worth 18,200, but because we see that it has been damaged physically, it's only maybe now worth 16,000. All you're doing with the impairment is taking what you would have calculated the carrying value at after depreciation, less what you think the value is worth, and that 2,200 will then be reflected as an impairment in the income statement. Now the new book value of this asset will then be the 16,000. Remember, this new 16,000 is now the new depreciable cost that we'll use for your remaining useful life. So if you're left with 2 more years, it will be 8,000 each year. Okay, if you've still got a residual value here in this calculation, remember you still need to subtract then your residual value of 16 less, let's say, the 5,000. Your depreciable cost will be 11 over the remaining useful life of the asset. Okay, so once an impairment has happened, it triggers a new book value, and that new book value less the residual value will be what we're actually depreciating the asset on going forward. Okay, that actually covers the assets section. I now want to also cover what is called the liabilities section, and your liabilities section also needs to be equally split between your current and non-current assets. Okay, so let's look at liabilities. Liabilities, you've got different types of liabilities. You've got accounts payable, you've got accrued liabilities, you've got deferred revenues, and you've got notes payable. Okay? Please don't also get confused with these terms. Accounts payable or trade and other payables, this basically reflects payments for your goods and services for your suppliers. So you're using these suppliers in your normal operations of your business. So your accounts payable, because it's used in the normal operating cycle of the business, this will then be classified as a current liability. Okay? If you've got accrued liabilities, accrued expenses, these are expenses that you've already incurred, you've already used up in your income statement, but you had not recognized them as an obligation. So at the end of the year, you want to say, I still have an expense that is due to either A or B, and I want to reflect that obligation. In that instance, your accrued liabilities or your accrued expenses will also then be reflected as a current liability. Okay, your long-term liabilities reflect all your long-term either notes payable that you've got, either a mortgage facility, a bank facility, a development finance institution facility. And for those long-term liabilities, you actually need to reflect these also in your income statement at the valuation of what you're obliged to pay. So for that, if the maturity of your long-term liability is 1 year or less, that will be in current liabilities. So whatever is due in the next year, let's say you've got a 50,000 Rand loan, 10,000 is due next year, the 10,000 will be current and the remaining portion will be non-current. Remember to just split your liability between what is maturing next year, what is maturing in the following year. Liabilities are quite easy. That's it on the liabilities side. Thank you very much.